All right. So our question says that we should prepare a consolidated statement of financial position as at what date?
31st March.
So 31st March 2013, right? All right, so we'll have our dollar sign.
Yes.
And then we're going to work in thousands as usual. So now all we need to do is, before we start, we'll do just like we did published accounts. However, we'll have some slight adjustments to the way we're going to walk through this. So first of all, what we'll need to do, or to be very comfortable with, is once you see this kind of question, I would take everything for granted now, and I'll just do it in one structured way. However, as we go on, maybe we'll make slight adjustments to our discussion. So what we're going to do is to have our standard workings. I'll explain some things as we go forward. So our work one will be the group structure. Right? As we said, then our work two
Net assets.
So work two will be fair value of net assets. Now, if we want to do this, we can do at acquisition. And then at reporting. Then we go down, and our next work will be work three, which we said was going to be goodwill, right? So when you get a straightforward statement of financial position, then you will need to just open the workings as they are right now. And then we'll start filling in the blanks as we go. So work four is NCI. And finally, our work five is our group retained earnings. All right, so that's our structure, the way we're going to work. So we just start from the beginning and pick all the information as we go forward. So we start with the beginning of the question. The question says, it says that on 1st October 2012, Paradigm acquired 75% of Strata's equity shares by means of a share exchange. So we see that the consolidation took place using two means: a share exchange and then a loan note. So all we'll just come and do, at least we can get our group structure quite simply. So we have Paradigm. And Paradigm in, I wish we could draw that line, in Strata. Okay, so let me take that out. So Paradigm, I can put it under there. I wish it could stay in the middle. In Strata, so what we have is 75% is control, right?
Yes.
So 75% control. And if we have 75% control, then the rest of it, 25% will be NCI. So that should guide our thoughts going forward. Now, the only other thing we need to remember is that it's a 6-month subsidiary. So 6 months, right?
Yes.
Where is it showing that it's 6 months?
We're preparing to 31st of March,
Okay.
and
Yeah,
then we
yeah. I
started
get
1st
you.
of October.
Of October. Okay.
Yeah, okay. So that's all we need for that. That has given us our perspective for what we're going to work. Then it says that the share exchange was 5 new, what's that? 2 new for every 5 held. We
Share
have
for
seen
every.
something like this before. So we just go down and maybe we create another working for it, particularly because this is the first time we're doing this. So we can have work 6 and we can have share exchange, or we can do all the purchase considerations here. So share exchange. Okay, so 2 new for every 5 held. Okay, now what did he say? It says for the shares that it is going to acquire, so we would say that the value, so the value of the consideration will be equal to the what we'll just do is the ratio multiplied by the number of shares acquired. This space is not enough. Number of shares acquired, and that multiplied by the market price per share of the parent. So market share price per share of parent. Is that fine? Is everybody here?
Yeah, we are with you.
Yeah.
All right. So therefore, the value of consideration will be equal to, and we can bring that down. So, okay, so let me put that here. Will be equal to 2 divided by 5 multiplied by 75%. That's what we're acquiring. Of how many shares does the subsidiary have? So we can go through the question and see how many shares does the subsidiary have?
20,000.
20,000. You see the 20,000 there, right? So,
Yeah.
so 20,000 shares, and that now multiplied by, what's the market price of the parent? I think I remember saying $2 on top. So the market price of Paradigm shares at the acquisition date was $2. Can you see that?
Yeah.
Yeah.
All right.
Yes.
So that's basically what we need. So our answer now, so that will be equal to, so we can do that now. 2 divided by 5 multiplied by 75% multiplied by 20,000. Was that 2,000 or 20,000?
20,000.
20,000.
So multiplied by 2. So that's giving me 12,000. I hope that's the same thing you're getting.
Yeah.
Now let me show you how to enter this. So what we'll do is we'll debit.
Time of this food ready.
And if we think, this is why repetition is all that you need for you to be comfortable with most of these things. If we think about what we said before, we're going to debit, credit, and credit. The same thing that we did, or similar to what we did earlier. So our debit entry will be, we're going to, not the same thing in this case now because of this entry. So we're going to debit goodwill, or what we'll call purchase consideration. I will debit that purchase consideration with that 12,000. However, there are some issues that we'll raise. We'll see that we would have ordinary shares would have its own portion. And then our share premium too will have their own portion. If we remember that, why I was saying similar to what we said before was, we said that ordinary shares will only take the value of what was there before, of what the par value. Ordinary share will only take its par value. The rest of it will go to share premium. Do you get what I'm saying? Now, please, I don't like the way this question is
Yes,
structured.
yes.
I don't like the way the question is structured in the way that it looks like if it is exactly the same.
Mr. Fine,
Yes, please.
how come it's 2/5? How is it 2/5 there? 2/5 times.
2 new shares for every 5 held. So number new divided by number held. At the beginning of the question, they told you 2 new shares for every 5 held. So it's 2 new for every 5 held. So if you want to get what the consideration is, it will be number issued by the parent divided by what was with the subsidiary. Is that fine?
Yeah.
All right.
Yeah, it's fine now.
So our ordinary shares now will now be 1 divided by 2 multiplied by that 12,000. While the share premium too would also be the balance. So that will still be 1 divided. I don't like the fact that this is 2. So it doesn't really help us see what we are discussing. So that is also 1 divided by 2 multiplied by 12,000. Is everybody clear about that? Is this 120,000 or 12,000 I wrote?
Yeah.
More like 120,000.
It's 120.
Okay, so let me remove 1 0 from each of them. All right. So that's that. And so we can come and write our is equal to 1 divided by 2. Yes,
I
please.
don't understand what happened there.
Me, I don't understand why it's 1/2, but I don't understand the 1/2 there.
The par value is $1, right?
$1.
Yes.
Par value is $1, right?
Yeah.
While the market price
is $2.
Price is $2.
Okay.
So therefore, $1 will, so par will go, always go, will go to ordinary shares and the balance to share premium. Is that fine?
Yeah.
Mr. Brian,
Yes, please.
assuming the par value, the market value was $3.
Exactly. So 1 will go to ordinary share, 2 will go to share premium. We have said this
Share
before,
premium.
just the same way we did it before.
Yeah, will you be doing 1/2? 1/3.
1/3, 1/3 and 2/3. And 2/3 for the share premium.
2/3. Good.
Yeah.
Thanks.
Yeah, so that's just like what we said before. So with this, we can just go to, and this has compelled me to start doing a few things. So let's go back and see how everything will work. So goodwill is going to get that 12,000. So we'll just go back up and set up our structure like how we did before, or like how we know how to do before now. So we'll have assets.
Okay, sorry, before you go there, sorry.
Yes, please.
Go back, that's working now. Go back down.
To the
Goodwill,
working.
why is it goodwill?
I'm coming.
And why is it goodwill? Okay.
The purchase consideration would always go to goodwill. That's your purchase consideration. And you will see, remember what we said about purchase consideration? We said purchase consideration would either be cash, share exchange, So we've seen how to do the share exchange now, very, very briefly, or a loan note, or a deferred consideration, or a contingent consideration. We said there are 5 ways the consideration will go. Now, this purchase consideration is basically increasing goodwill. That is what you're going to use for goodwill. As we practice this now, you will see how,
How do we know? Yeah.
by standard,
How,
if yeah, I want to hear what you're asking.
yeah, how do I know by looking at it? How do I know that okay, it's supposed to be goodwill? Because if I was in my own mind, I was thinking it's going to be it's either debit cash or something else. I don't know, but not goodwill. Goodwill didn't cross my mind.
Okay, so it's any at the beginning of questions generally, and whether it was at the beginning or not, whatever is paid to acquire the subsidiary will be part of your consideration. If you think about it, the reason why you're giving the subsidiary those shares are not because you want to help the subsidiary or you like the subsidiary, because you want to acquire that subsidiary. So that was the price paid for acquisition. So anything that is part of the price paid for acquisition will go to goodwill. It will be part of your purchase consideration under goodwill. And because this is the first one you're seeing, that's why it might look, as time goes on, it will become second nature. You will not even think about it again. But the purchase consideration is what you're using to get. So remember, you're saying your total consideration minus the net assets will give you your goodwill. If you remember our definition. Now, this is part of your consideration, and that consideration is what you would use to compute the goodwill value. Is that fine? Okay, yeah, it's going again.
For now, let me just agree. Let's be going.
Okay. All right. So just agree. All right. So after current assets, what do we have? We'll look at equity and liabilities, right? So let's just put our equity and liabilities like what we did before. So under equity and liabilities, we'll first have equity. For those of us that are very pedantic, we cannot possibly have what do you call it again? A statement of changes in equity in this one. It will just be just a statement of financial position. So non-current liability, and finally, we have current liability. Did I leave enough space for you? 1, 2, 3, 4. That's more than enough. Okay, so as always, what I'll try to do is to get my. I've not even seen how the question is structured. So at the end of the day, I want to get my total equity and liability somewhere and compare it with my total assets. And then we'll go up and put our total assets. So somewhere here. Okay, all right. So where's Kingsley? Kingsley, please, I need you to be around somewhere. So under our equity now, that's where we'll have that ordinary share and share premium. Or better still, if you want us to go gradually through this, let's go and pick them one by one so that we'll see where everything is going. And I won't be jumping up and down, so I'll try and be as deliberate as possible. So if we go to that our working now, we have goodwill, 12,000. So we go to purchase consideration under our goodwill. So if you will, I come to goodwill now and I write purchase consideration. Under purchase consideration, my first under purchase consideration, my first purchase consideration will be share exchange. And in order to just help you join things together, maybe I can call this work 6 so that you know where that figure came from. And that will be equal to that figure there. So that's 12,000. So that goes there. And then we'll go to our ordinary share now. So remember under equity we'll have ordinary shares. And share premium. Okay, so if we follow what we've said before, we can have work 6 for this. So we'll have work 6 so that they will know where we brought the other figure from, and work 6 for the other one. So we can go down and, we'll definitely have the one that is coming from, and please, this is where you have to be careful that it's not the same way we did the other one. So we'll go here and say, we'll go and pick our ordinary share figure from our work 6. What was going to ordinary share was this amount, right? And then what's going to share premium? Yeah, from that, we said ordinary share, we're going to credit ordinary share with 6,000 and share premium with 6,000. So those are the figures that are going: 6,000 ordinary share and 6,000 to share premium. Please, let's remember something. Remember what we said about consolidation, that in consolidation, the parent is going to acquire all the assets and all the liabilities of the subsidiary. Everything, no matter the time of the year. So even though this is 6 months, even though this is 6 months, we're not going to prorate the 6 months. We're just going to, because a statement of financial position is the value at a particular point in time. That's why we say as at this date, what was the value? That's all you pick. So if it was 1 million 1 week ago and it is 0 today at the year end, then it is the 0 at the year end we're going to take. We're never going to prorate for statement of financial position with regards to assets and liabilities. Now, the other thing that is important is that it is only the parent's information that we are going to be representing in our financial statement. So everything about the parent will be recognized in our financial statement. So once we start working through once we get through this, then I'll show you what I'm saying. And I would appreciate that even more clearly. Stuff that I know that we have seen before, maybe not with this level of detail, but stuff that we have seen before. So we've put all our share exchange for the purchase consideration, and then our ordinary share and share premium values. So we can move on with our question. Now the rest of the question says that paradigm issued to shareholders, to the shareholders of Strata $100 10% loan note for every 1,000 shares it acquired in Strata. So this will be similar to, now just see the logic behind it, beyond me saying it will be similar to anything. So let's see the logic behind this now. So the second one is the 5th consideration we said we can possibly have. So we said,
serious signing this should become.
so work 7.
Because na just 6 hours flight, no. Na UK.
Work 7 loan note. So our loan note now, the loan note value. So the value will be equal to what was acquired. They said
Plenty.
they say $100. Please keep your stuff on mute because other people that will hear us. Please try. Okay, so they said $100 for every 1,000 shares it acquired. So the value for the loan note will be the value given divided by value received, or value received multiplied by the number of shares acquired. And that's not a formula that makes any sense. All we just need to do is to say that that will be equal to I don't know that it will be equal to. So what we have now will be $100, right? Is that what they said? They said $100 for every
10%.
1,000 shares. So divided by 1,000 shares multiplied by, we're acquiring 75%. If we go back to what we said before, 75% of 20,000. So this is standard procedure. Some of the things you're seeing now, that's how it's going to be world without end. So you don't need to worry about anything. Okay, so this figure now will be equal to 100 divided by 1,000 multiplied by 20,000. That's 2,000. Is this clear?
Mr. Brian,
Yes, please.
what if we do it this way that since it's 1,000 for every shares, that means it's going to be 20,000 over 1,000 shares that they will be offering $100 for.
It's the same thing.
Yeah, you know, understand, to save it in the head now, because
Yeah, so go ahead and say that now. Go ahead and say that. I don't know that everybody will like it like that. See the way me I would have done my own. See the way I can come here now and say, I have 100, right? $100 will be equal to X. I don't know what X is. But I know that I'm going to give 1,000 shares for, what was that again? For 75% for 20,000, right?
Yeah.
And then I can cross multiply this. So if I cross multiply it, it will be 100 times 20,000 divided by 1,000. And this will kill that. Two more will kill 2 more here. And what I have is 2,000. So anyhow you want to do it is fine. Do you get what I'm saying, Kingsley?
Yes, boss.
There's no way that.
I don't know which one will be easier for everybody though.
And so that's all. I like what you said. Anyone we use is fine. It's acceptable. Is everybody fine with this?
I understand I know the cross multiplication, but I don't understand the something 100%, $100, 10% loan note for every 1,000 shares.
They said for every 1,000 shares I'm buying, I'm going to give you $100 loan note.
Yes.
So it means that for every $100, I will acquire 1,000 shares. So if I am buying 20,000 shares or 15,000 shares, if you will now, right? That's 15,000 shares now.
It's 15,000 because 75%.
So why did I hope we did that 75%. Oh, we just said 2,000.
No.
It's 75%.
Yes, you
Yes,
didn't do it.
Okay, so multiplied by 75%. Multiplied by 20,000. So if I'm buying 15,000, which is 75% of 20,000 shares, if I'm buying 15,000 shares and I'm giving you 100 for every 1,000, I will pay you 1,500. Ella, do you get what I'm saying? So
yes.
I've said that a way to think about it would be the value I'm giving you, which is $100, divided by the value I'm receiving, which is 1,000 shares, multiplied by the amount of shares acquired, will still give you that value. if you want to think about it like that, fine. If you want to think about it in terms of cross multiplying, for every 100, I'll get 1,000. I'm buying 1,500 shares. How much will be my value? If you do that cross multiplication, you'll still get the same 1.5 in this case. Is that fine?
It's fine.
Okay. So now, all we'll just do is we'll think about what our entries will be. So we'll debit and credit. They tell us when they are redeeming that loan note, how long is going to take place, how long is going to be held for. No information, right?
No information.
So all we'll just do is say, would goodwill will get that value. So goodwill will give that 1.5. And then our credit leg will be to non-current liability. And that was why they told us that they had other loan notes in the first place. So that non-current liability will get that same 1.5. So see the difference between this one and that one. So all we just need to do now is to take our, so we go back up to goodwill. And all we will just say is loan note. Loan note work 7. And for our loan note, we'll just go and pick that value. So it's equal to whatever the value was, 1.5. So that's going to goodwill. And then the other thing will be to non-current liability. So we would have our loan note here. So loan note, even though we might have another loan note. So we can call this work 7 and then go. So we're going to put that where we put the things that we're adding, that we're working for. So it's equal to, so this one now is equal to, and we go and pick our figure from there. So 1.5 for the non-current liability. And that's that. So that has taken care of those ones. Is this clear to everybody? Any question? All right. So if we go down, they said Paradigm has not recorded any of the purchase consideration, although it does have 10% loan notes already in issue. The market value for Paradigm shares as at 1st October 2012, that's at the date of acquisition, was $2.
$2.
And then they gave us the summarized statements at the end of the year. So we have everything we need. And we're basically done our purchase consideration. The next thing to do now is to go and start filling in the blanks. We're only going to recognize, so we're going to start recognizing our values in our statement of financial position. So some people would like to write parent and subsidiary. Okay, because I did those things, maybe I should have to shift them now. Okay, the only one that is affecting really is this one. So maybe I'll shift these ones to the third place. Where did I put? Okay, so that's absolutely fine. So let me just see whether I can carry these ones. So let me carry them, shift them so that I'll have parent and subsidiary without any problem. I'll show you what I mean now. All right. So now, all we're going to do now is we're going to just copy and paste what we have in our financial statement from beginning to the end. And we said assets and liabilities. So we start with the parents and we're going to be adding across. So we start with PPE now. What's our value for PPE? Please, can you call? Let's move. So PPE is what?
For the parent, it's 47,400.
47,400. And then for the subsidiary,
Yes.
remember we're adding the subsidiary 100%.
25,500.
You said how much?
25,500.
500. Okay. So what's next? Financial asset, right?
Equity, yes.
Note
But it has a
one.
note 1.
Okay, so we can keep that there. We can leave the financial asset until we work it. We can keep that, or we can write it there and then make the adjustment. That's absolutely fine any way we want to do it. So we can leave the financial asset generally when we have a note to it. Then inventory is the next one, Abi. I didn't know that. Okay,
Yeah.
so please remember one thing. Every time you're doing consolidation, There's something that will always come if you're doing a statement of financial position.
Goodwill.
So goodwill will be a non-current asset. So we can keep our goodwill, and we can easily say work 3. We know that that's the standard working for that. We can also put work something here. So we'll see what the working for that is. So we'll go to current assets. We start with inventory. Inventory is what?
So it still has notes attached to it.
Yes, but we can be comfortable, unlike the financial assets that can be financial assets that will change in fair value. The inventory will just be an adjustment. So we can feel free to write the inventory. If we need to remove it, we'll remove it. So let's just call inventory. Inventory is what?
17,400.
And
84.
18,400.
84.
84, sorry.
8400.
Yeah,
And then what's
84.
next?
Trade receivables.
So receivables, how much?
14,800.
That one too has a note.
Yeah.
So receivables. You say, what's that?
48 and 9,000.
14,800, 9,000, 14,800.
Yeah.
So this will log us out now. 14,800, 9,000. Okay, so when we come back, we'll just finish the remaining. So let's go until it takes us out. What's next? Bank, Abi?
Yes.
Bank.
Yeah.
Yeah.
So bank only for the parent, 5-1, right?
Yeah.
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 5-1.
All right, so we go to equity.